Akin, a pleasure chatting with you today. I hope you're enjoying Nairobi.
Oh, yes. Thank you very much. Nairobi is lovely.
Okay.
I'm a sort of mathematical sort of person. And I always liked economics as a subject, right? So I always thought there was always the idea of ending up somewhere in the economic field or in finance. And I did the first degree in accounting, which I found quite limiting and dull. So I wanted to do something else. So I did an MBA, which was sort of a finance-centric MBA. And I found corporate finance especially particularly interesting, which I explored further by then doing the CFA exams and becoming a charter holder. So the idea was always, well, I'll probably end up somewhere in finance. Now, I'm Nigerian. I ended up working back in Nigeria, and in those days, the banking sector was the most developed sector in the financial sector by far. You didn't have that much going on in the MBFI sector, though you did have sort of an emerging sector in the MBFI space as well. So I ended up in the bank because that was where my overall skill set was best served, given the architecture of the economy at that particular point in time. I think the increasing adoption of electronic and digital channels across the board, the role of technology, investment in technology, I think has been a significant development over the past decade, maybe plus. Financial inclusion is also picking up at a decent pace, right? Though I'm not sure branches are increasing at a similar pace. I think, again, the use of electronic channels and other channels has meant that branches are not as central to, say, growth and financial inclusion as one would have thought historically. It's not as directly correlated as one might think, even though I think still in some areas you do need a branch to reach certain segments of the population. So I think banking in Sub Sahara Africa has grown considerably. You see, over the past 2 decades, you see the growth in the what you'd call the national banks, the African banks. It's been really, really phenomenal, right? And you've also seen the rise of the African banks. So a lot of these national banks have become African champions. You see the Kenyan banks, you see KCB expanding into neighboring countries, expanding into the DRC, acquiring banks. You see equity, just to use 2 Kenyan examples, you see the Nigerian banks all over the place. That's been a big change over the past 2 years in SSA. I think it's been a positive one, really. Because in the end, national banks are going to be big drivers of the financialization of the economies and the development and growth of the economies and facilitating that economic intermediation that all the countries need. So I think there have been many, many changes, but just to mention a few, I would say digitization, use of electronic channels, growth in financial inclusion, and the rise of the national banks, of the African banks. I think that's been a really significant trend over the past few years. A step very much in the right direction, right? Africa needs it. Africa was not set up to trade with itself. Africa was set up by the colonial powers to export raw materials to European capitals for the most part, and we've not generally managed to look inwards for our own economic activity. So we export raw materials, import finished goods. I mean, that's a crude generalization, but it's not too far from the truth, the reality. So the Africa Continental Free Trade Agreement should reverse that considerably. I mean, only last time I checked, and I'm sure it's changed, only 15% of African trade is intra-Africa. The rest is with the outside world. You go to Asia, the ratio is about 56, 60%. The EU trades about 2/3 with itself, and then the rest with the rest of the world. Africa has to move from that 15% to something much more like where the other regions I've mentioned are. And the benefits in terms of growth, even our own balance of trade with the outside world as a continent would be humongous, would be huge. And of course, there's many a slip between cup and lip. It's a long way to get there. You have to remove frictions to trade, the borders, ease of access, tariffs, and other non-tariff barriers have to be eased. Travel, logistics is a big problem. You can see how Africa is set up in how difficult it is to connect within the continent, right? All that has to change. And trade can change that. Trade can change that, and people reorientate and reprioritize how they move about. And so I'm a big fan of the AfCFTA city. I never can quite get the initials. African Continental Free Trade Agreement. Yes, AfCFTA. I think that's it. I'm a big fan of it. It's probably a bit overdue, but the next best time to do something is now, and it's good that it's started and that countries have signed up now. Really making it happen and work is still a lot of work. It's still, again, that's where the political will comes in. I mean, from a trade perspective, protectionism lives in Africa still. And there's nothing wrong with protectionism. Well, let me take that back. Protectionism has a certain logic of its own, especially politically speaking. But economically, I think the evidence is pretty strong that it doesn't help growth or competitiveness. And Africa has to compete with itself. If Africa is unwilling to compete, if African countries don't want to compete with themselves, then who can they compete with in the world? So I think it's a real opportunity for us to cut our teeth by trading with each other and improving and becoming more competitive. And it will help us trade with the rest of the world. You create scale, you create economies of scale because of size. You learn skills, you transfer skills, you create a big marketplace. If you think about, and I'm going to get a bit political here. If you think about the OAU and the founding fathers of Africa, Haile Selassie, Nyerere, Kwame Nkrumah, all these people, they were very focused on political union. I know certainly Nkrumah was. But really, economic union is where they should have started from in terms of the focus. Because without that growth and that development, the politics will always be even more complex. It's complex anyway. But I think Africa has to really focus on that. And I think this is a great opportunity. I hope we make it work. Let me start with the positive. I think East Africa generally has a very strong ease of doing business environment. I think on the continent, East Africa compares very well with the rest of the continent as a place to do business. Institutions are comparatively strong. Policies are relatively liberal. Encouraging capital in, allowing capital out. And generally, rule of law is pretty decent. I mean, not perfect by any means, but pretty decent. So broadly speaking, I think East Africa is strong in that area. That's always been my perspective. West Central Africa is a little complicated in many ways. There's the Francophone axis, there's the Anglophone axis. It's from a regulatory perspective, the approach is more active, shall we say, in that part of Africa, and it's probably become more so over the past few years, right? And it's been interesting because we operate across all these jurisdictions. It's been interesting to compare and contrast the differences in the approach and the way you have to adapt to it. And I think we've done that very well as an institution. I think the banking sector generally has had to do that and has done so. I think something like the AFCFTA, and as the economic situation post-COVID stabilizes again, I think we will see more of a reversion to a more liberal markets approach from a regulatory perspective across the entire Sub-Saharan African space. And I think that will be very good for SSA economies and for the participants in it. A lot of pent-up inflation that had been building up over time, I think with the Russia-Ukraine war as a catalyst, was unleashed in the past year. And the response from the monetary policy makers in the US and Europe was very aggressive, with interest rates going up very sharply. So that low interest rate era, for now, has ended. And quite decisively too over the past year, really. So look, for us, it's Tuesday. The world changes, we change. The world has been, Citi has been in 100-odd countries for a very long time, probably more in the past. And the world has changed many, many times over. Citi is 200 years old. Its international footprint, I'm sure, is over 100 years old. I'm sure the first country would have been opened over 100 years ago. We're very experienced globally. And, the world has gone through so many cycles in that time, right? Over 200 years, you had if you're a student of economic history, you would talk about La Belle Epoque, right? 1870 to 1910, Citi was there, it existed. The First World War and the changes in that's when government started to issue a lot of local debt to pay for the war, after the war, and the debts they'd run up. And that saw the, sort of the development and growth of significant domestic bond markets in many ways, in the way we recognize them today. The interwar years and the rapid growth and enthusiasm of that period, the Second World War, then the post-war society, the end of colonialism, the independence movements in our part of the world, the economics of that, the idea of the welfare state and the big state. Then by the time you get to the 70s, the neoliberalism, Thatcher, Reagan, and that filtered down here too, eventually via the IMF and policy changes. Then the global crash in 2008, the end of that era, change towards a more assertive, muscular sort of, again, with a greater role for the state bailouts. Africa also, again, adjusting from a more liberal approach, broadly speaking, which I talked about earlier. Interest rates go up, they go down, they change, we'll adapt. It's what we do. We have a lot of, there's a robustness that comes from long history in the markets. And I don't even see where interest rates are globally now as high. It's really a normalization. If you look at it in historical terms, this is sort of reverting to the norm. What we've had in the past 10, 12 years post-financial crisis with virtually zero interest rates was very much anomalous. So this is, to us, I think this is BAU really in many ways, and we're equipped for it. Yeah, no, at Citi, we more generally, I think we have a net zero commitment, which our CEO, Jane Fraser, articulated upon taking office a couple of years ago, if I remember correctly. And that's definitely a very big theme for us at Citi. We also have commitments regarding ESG and the financing we're going to bring to bear to support ESG across our organization, across the world, really. And, E is very important. I think the environment is very important. And I think we in Africa have to recognize that environmental change is already occurring. It's not something, I think sometimes there's a tendency for us to think it's something the West are preoccupied with and it's not for us to worry about. It's already happening. It's happening to us. It's happening to us. You have floods that you never used to have. You have droughts. You have creeping desertification from the Sahel down. You see it in West Africa. And you see the socio-political impact of it, very significant, security impact of it. So it's already happening to us. I think it's important that we as Africa recognize that, while still trying to find the right balance and get the right support that we need, which I think there's been a lot of focus on. But as Citi, we're interested in supporting that transition to sustainable energy sources. The environmental part is a big thing with us. And like I said, we do have commitments. We look for funding. We are able to intermediate funding to support such projects. And we also think the S is important. The social part of the ESG agenda is very important, especially in Africa, where we have a lot of social issues around poverty, around water, food security, around housing availability, around just... So the environment is a key part of it, but the social aspect is also very key. And we've been involved in a lot of projects across the continent, using our balance sheet, leveraging on the balance sheet of other development financial agencies to do different things. I know there's the Green Light Planet here in Kenya, which I think solar power generation in Kenya. We have 1 Acre Fund, which is operating in about 9 countries across East Africa mainly, but also West Africa, supporting agriculture and generally small-scale farmers, trying to help them scale up and develop. We have something we did with a logistics provider in Nigeria called Babangula, which is in the agri space as well. So we're in fact, in the strategy session we had, there was a segment dedicated to social finance. And there was lots of discussion about the environment as well. Trying to figure out how we can help and assist. You know, we're in countries like Congo and Gabon and Tanzania. They're all part of the Congo Basin. And there's lots of talk about how to leverage the assets of the Congo Basin as a net. What's the opposite of emitter? They don't emit carbon, they actually absorb. Yeah, it's not the word I'm looking for, but and how to convert that. Carbon credit. How to convert this into carbon credits and to use it as a means of raising funding for the countries to encourage such activities that preserve carbon and preserve the environment. So there are a whole myriad of things we're looking at and working on in practical terms, looking to support the countries we're in with regards to sustainable energy, the transition, and social objectives, social finance objectives as well. As banking penetration increases across the continent, right, and financial inclusion is driven, I guess the challenge has to be continue to sustain the risk and controls architecture that will continue to protect the banks from the various risks that it faces, right? That they face. KYC, AML is very important. And that's an area to focus on, because as you grow and you expand your services to the population, your ability to check and to make sure that you're banking the right people is made more complicated, right? Identity protection is a big issue in our part of the world. So one of the historic stumbling blocks to retail banking or consumer banking in Africa has been identity fraud, for instance. How do you know this person is who they say they are? So, KYC is a big part of that. But even just the fact that you need the improvement in biometric technology, the use of national ID cards helps the banks as well to identify who their clients are. And I think managing those risks, managing that exposure as the banks expand is going to be critical to sustaining the growth that will come with that expansion. Let it not be a question of you grow and then you run into control issues later that force you to retract or to change. So that infrastructure, the identity infrastructure, the KYC and infrastructure, I think will continue to be a focus area for regulators and in terms of monitoring the banks and their activities, and make sure that their expansion, which is very positive in terms of economic intermediation and economic growth, is not derailed by those risk factors. And even from a credit risk perspective is important. If you're going to lend money to individuals and to consumers or to small businesses, you need to know that they are who they say they are, so that you can get your money back, basically. If you lend to this person and it turns out to be somebody else entirely, that becomes a challenge. So that infrastructure is very important. Regulating it is very important. And that will support the sustainable expansion of financial services across the continent, which I think is what the regulators want anyway. I think the focus has to be on that area and on enabling other solutions. You talked about fintechs earlier, talked about mobile money. The regulators also have to find a way to enable those innovations alongside regulating the banking sector appropriately. I don't think it does Africa any good if the banking sector, if the banking sector growth leads to the stifling of other channels and options for financial intermediation. So the regulator's job really is to enable banking sector growth, but to enable innovation in a safe and sustainable way as well. So it's not easy. The world is changing. Technology is changing all the time. So the regulators have to be adaptable and to be ahead of the game. The fintech bank relationship is a very interesting one. Are they partners or are they competitors? So, we could debate that ad infinitum, right? But I think we as Citi, we've always seen fintechs as partners, people we can work with, we can collaborate with. And I think that's, I think it's inevitable that they exist, they're here. So we'll have to cohabit somehow in the financial services space. I think they have a role to play in expanding financial services, microcredit. You see some of them very active in that area. It's up to the regulators to manage that, because it's a fine line sometimes between microcredit and predatory activities, right? Which is why I say the regulator's role is very important. You have to allow the innovation, but you have to make sure you manage any potential abuse, if you like. So I think they can complement each other. The banks and the fintechs can complement each other in finding solutions to Africa's banking challenges and to financial inclusion on the continent. And I think it's up to the regulators to define the architecture that will encourage that complementary behavior, as opposed to what we sometimes see where it's more adversarial and it's defined as such. I think there's scope for collaboration. I think Africa is, the opportunity for growth is great enough to accommodate different types of players and to encourage adaptability and innovation on all sides. I think the fintechs keep the banks on their toes in many ways and keep us thinking about different ways and different channels in which to serve our clients. And I think that's good. That's good for us and for the whole industry. football team is, you can have your tactics. You have your team, you have your 11 players on the field, and you can decide how you want to play, right? Do you want to press high? Do you want to drop deep? Do you want to play 4-3-3? Do you want to play 3-5-2? How do you want to do it? But you also have to account for the opposition, right? And what they might do. And, where's the balance? Some managers would simply focus on their organization or their team and say, these are our tactics, this is how we play. I don't care what the other guys do. If we implement and execute our tactics, we'll be successful. So, football managers do that, corporate managers do that. I focus on my own team and make sure they do the right things. And when we get out there, if we execute, we'll be successful. Then, you have the other school of thought, the famous Mike Tyson quote about, everybody has a plan until they get punched in the face. So how do your tactics survive contact with the market or with the opposition in football? And when that contact happens, how do you adapt? Because sometimes you have to. How do you tweak? So I see parallels between the two. How much of it depends on you and your strategy, and how adaptable those strategies are to the inevitable realities of the marketplace or the football field. The person who determines that faster, who figures that out, that balance quicker, and adjusts, generally wins. But teams are always stronger as a cohesive group as opposed to individual or star players. The teams win. You can adapt tactics and all that, but fundamentally you have to have a team. The team wins. And it's the same in a corporate environment. The team wins. Individuals don't win, however talented or good they are. So I think there are many lessons and analogies to be drawn between the two areas.